Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. On this episode, Portfolio Manager Sri Tella discusses the outlook for bond markets in the second half of 2024. He anticipates gradual rate cuts with the Federal Reserve focusing on employment and inflation while keeping options open for more aggressive cuts if needed. Sri highlights the diversification benefits of fixed income, saying that it has more stability against a high market volatility environment. He talks about how historically, fixed income has shown an asymmetric return profile at market cycle inflection points. Sri also discusses the outlook for rate cuts in Canada, saying he expects the cuts to continue, though much of this is already priced into the market. He touches on the current positioning with defensive sectors, noting a shift towards higher quality within the corporate space, explaining how provincial bonds are favored for their lower volatility and better liquidity. This podcast was recorded on August 23rd, 2024.
Hi, Sri. Great to see you. Good to catch up.
Morning. Good to see you too.
Great to have you join us. Is there anything in the remarks they're sort of dribbling out? There's various points coming out, obviously, in this speech that changes what maybe we should say markets think is going to happen in September.
Yeah, I think the biggest thing is the comments from this morning solidify kind of what's been priced into the markets. I would have argued ahead of today, at least my own personal opinion was that a fair bit was priced in and that rate cuts would probably be a little more gradual than what the market had been expecting. But I think what Powell really emphasized today was one, that the focus is shifting from inflation to the employment story, which we've seen some weakness in. And the other thing that I think was notable from his comments this morning is, unlike some other Fed speakers recently, he left out the word gradual in terms of the pace of cuts. And so I think what that's done is validated that the Fed's trying to keep its options open, but that there is the possibility, if the data was to turn more negative, that they could be more aggressive in terms of cutting rates going forward.
If they need to. Yeah. Did sort of 50 basis points in September would not be gradual. And they did remove that word. So maybe just add on to that, like what you take from that. Is that?
Yeah, I still think that that's a very low probability, but, reading some of the commentary that's coming out post his initial comments, that there is a probability being added to a 50 basis point cut. I do think it's a little early to sort of think about that. There's still some more data to come before the September meeting. But I also think, just like with inflation, they're going to want to see some of the data over the next little while before they get more aggressive. So I think 50 basis points in September would send a bit of a panic message and maybe spook the markets a little bit. So I think I would say that my own personal opinion is that 25 is kind of the likely scenario for the next meeting. And we'll see how things play out. The one caveat to that is that employment data tends to be a lagging indicator. And so by the time you start to see really negative prints, that could be a bit of a sign that things it's a little too late. And so if the Fed's thinking about that, they may want to be a little more aggressive.
How closely were you paying attention? Of course, you're paying close attention, but how much does it move the needle that we had that big revision in non-farm payrolls? It was big, but it was also over the course of many, many months, but it's a lot less jobs than we thought.
Right. I think there's two ways you can kind of be pretty balanced in the way you think about it. So it depends on your viewpoint. You can sort of spin the story the way you want. On one side, it's the largest revision since the global financial crisis. And so that's a big deal. I think people were looking for that given the last payroll numbers that printed. And so I think that feeds into the rhetoric that the Fed needs to be a little more aggressive. The flip side of that is we've had some very strong job growth. So jobs have been strong, numbers have been high. So even though you have a fairly sizable revision, there has still been a sort of healthy amount of jobs added over the last number of over the past year plus. And so I think that's something that people need to consider in light of those revisions as well.
I want to dig into the Canadian markets in just a minute and get sort of a bigger picture on that, but it is Jackson Hole, so we're going to talk about this right now. You had read something just recently. It's a little bit of a case for fixed income. You have your own case for fixed income, but there's something you read that was kind of interesting. I wonder if you just share that with us.
Yeah, so I guess there's kind of 3 points that kind of put things in perspective that solidify sort of the story that I think myself and colleagues of mine have been mentioning about fixed income and its attractiveness. So the first is that when we enter this kind of this part of the market cycle, when inflation is slowing down, growth is starting to slow, and you're seeing rates being cut, the negative correlation that we've historically assumed between bonds and stocks reasserts itself. And so we've obviously come out of this inflationary period where where correlations went positive, but in this type of environment, it really does add to the diversification benefits that fixed income provides in a portfolio. The second point is that interest rates being much higher than they have been, even though they've come down more recently, do provide income, and they also allow for protection against volatility in rates, and so you're earning some yield while you're in this range-bound environment. And the last thing that that was interesting to me was this notion that if you look back historically at these inflection points in sort of the market cycles, there's an asymmetric return profile for fixed income. You know, if we get this slowdown or a real sort of shock to the economy, you will see rates rally considerably, providing positive returns. In the event that we don't, given that the likelihood of fixed income staying range bound is more likely than seeing a spike in yields. And so therefore, you're either going to kind of earn your yield or have some extra positive return from a rally in rates. But in this type of environment, you historically don't see the flip side or the downside on fixed income.
That's really interesting. I mean, all of them, but that final piece particularly. Let's go back a couple of weeks to, I mean, it seems like ancient history at this point, but the markets just went nuts, and we know why. And we know that there was a rotation, and there was a yen trade, and we had other things that were sort of this trifecta within the overall market. Bonds did their job in that moment. It was sort of another feather in the cap for those that were concerned that maybe bonds were too related to the moves of equities and so on. But fundamentally, it was sort of good for the bond story. I mean, do you come out of it with that? Is there a message there?
Yeah, I mean, I guess I think really the positive for bonds, it really goes back to the point about diversification, and when you see a risk to the market and to the growth story, and if you're seeing equities have some pretty large declines on those days, and that kind of feeds into the flight to quality going into fixed income. So I think that's where the benefit was, and that's why we saw that happen. Plus, when you get these sort of scares in the market, there's also the notion of that central banks will need to react and cut rates, and so that leads to pricing in additional rate cuts, and which is what we saw. A more aggressive rate cut path priced in, and that's what then helped the bond market in that period.
Because there's so much room for the Fed to step in and solve things if there is an issue, if there's a massive growth scare, doesn't that just sort of let people be riskier? I mean, I'd like to know from your side of things. There's an equity story there too, but even just from a fixed income perspective, when you know the Fed has so many tools to use should things go a wire, can't you just sort of have the wind at your back there in terms of risk?
I mean, I think that's been a risk of sort of central bank policy, or what we've seen out of central banks over the last number of years, that there is this notion that they'll come in to sort of save the day. But I do think that there is kind of a threshold before they react. If we, in an environment that we saw a couple of weeks ago, I think there were people calling in the marketplace that were calling for emergency cuts out of the Fed. But I would argue that it would take a much more significant impact before they start stepping in. Obviously with COVID, that was sort of a really big deal that warranted sort of some of those massive rate cuts at the time. But I think if we see kind of that sort of volatility blips of what we saw a couple weeks ago, I don't know that that's enough to get them to jump in. But that being said, if you go back to, this was the argument that was made way back when rates were at zero, is that the central banks really wanted to get off the lower bound because they needed to give themselves a cushion in the event that another shock to the system happen. And so we're at that level now where rates are high enough that they can react should something hit the market.
I mean, and if we look at Canada, it's old news. We've been cutting for a while now. Like this is we know where we're going. Do we? We're on the road. We know where we're going. Are we going to see another rate cut right away? Do we need to?
Yeah, I mean, I think broadly the story's similar to what we're seeing in the US. Obviously, Canada a little bit had been a little more vulnerable to higher rates given indebtedness and the sort of linkages of the mortgage market in Canada, the nature of the mortgage market in Canada. So the cuts that we have seen were warranted, and I think we will continue to see more. There's a bit of a dilemma in that, economic growth is still somewhat strong, but we are seeing inflation come down well into the Bank of Canada's bands. If you look at sort of 3-month trend of inflation, it's comfortably within sort of the Bank of Canada's range. And I think similar to what the Fed's been saying is that, I think that the central banks and the Bank of Canada are comfortable that inflation is now in check. And so the shift will turn to sort of other parts of the economy and sort of the impending mortgage rollover risk that Canada faces with higher rates and things like that will impact the economy. So I do think that we'll continue to see them in Canada, but again, there's a lot priced in already. We're looking at 150 basis points of rate cuts over the next year in Canada, which I would say is maybe it's becoming more of a base case, but that's still a pretty aggressive path.
Why is it aggressive? Why is it aggressive? I mean, it is restrictive. Canadian companies are spending a lot on capital. If we don't need to be up there because our inflation is coming down, why is it aggressive to cut, more than what you're thinking?
Yeah, so I think there's there are a number of factors, but I think that the two key things right now are, if we think about population growth in Canada, which is still supportive of growth, that's really sort of helping the growth story. You also have a dynamic in the marketplace where there is sort of pent-up demand, especially for housing. And if things become more attractive in terms of borrowing for purchasing housing, that dynamic is something that's been really tricky for the Bank of Canada to navigate because of the supply-demand imbalance in housing. And that's another thing that could refuel things. And not to mention on the employment side, while jobs have cooled off, we're not seeing people lose jobs. And also, at the same time, wage growth is still pretty high, north of 5%. And so that's something that's on the Bank of Canada's radar as well.
So we can grow through with rates at this high. I mean, at the moment, it's we're okay with them at this high, or maybe a bit lower, expecting.
I wouldn't say maybe at this. If they stayed at this level, that's going to be fairly restrictive. But if you look at what's priced in. If you look at sort of what's priced in 3 years forward, that's kind of a timeline that we look at when we price. We're looking at sort of short-term rates 3 years forward, right around 2.75% right now. Now that's down about 50 to 60 basis points from just a couple of months ago. And if you think about a 1% sort of neutral rate that the Bank of Canada has pointed to, or maybe even slightly higher, and then 2% inflation on top of that, that gets you to kind of a neutral rate in the 3-ish% range. And so a lot is already priced in to sort of get to that less restrictive sort of rate level down the road.
When we look back again at that market action 2 weeks ago, 2.5 weeks ago, there were a lot of things in there. One of the things that was in there was a truly sort of external event. It wasn't a data related story. It was a carry trade story that had to do with the currency of a foreign country and the whole dynamics of that. I'm just curious about your risk tolerance at this point of that particular trade being completely unwound, but also sort of the exogenous shock story, whether you link it to geopolitical, whether you link it to something else. But I'm just sort of curious where your very good research and a little bit of spidey sense and big brains take you down that story of, what if there's an exogenous shock, not unlike that carry trade issue.
I guess first, just as one thing I would say is, while this was, currency related sort of trigger, I would argue that it is somewhat connected to data and sort of interest rate policy, because that's what drove the trigger in terms of the notion that the rates in the US would start falling more rapidly, kind of reverse the economics or change the economics of those carry trades. And then you have, like in Japan, where you have rates biased to go higher. So that kind of reverses the dynamic that feeds those trades. And so I think that's kind of what sparked sort of the unwind of those positions. But I think it does kind of point to positioning in the market, that there is, there could be some pain to be felt as things slow down. And when you look at when we look at our portfolios and think about in Canada and in the US and look at valuations in credit markets, while there is a case generally that fixed income is attractive, and so we continue to be comfortable having exposure to credit because of the demand for bonds. At the same time, when you look at valuations, you don't necessarily want to have a lot of risk, given that we're at the tighter end of historical ranges. We're through historical averages. So we want to give ourselves a lot of dry powder to add to exposure when the volatility sort of surfaces. And so we're more defensively positioned, but we still do have exposure in order to maintain a level of yield in our portfolios.
Okay, it's fascinating, and some dry powder, as you said. A couple of questions rolling in. One, you've pretty much answered. The other, I'll put this to you. How do you see the flow of money markets to bonds versus equities, for instance? This is all a yield story, certainly the money markets to bond story. Why the move, the flows there?
So moving from money markets into bonds?
Or versus from money markets into equities?
Yeah, I mean, I think that, if you're picking one versus the other, of course, I'm going to have a bias being a bond portfolio manager, but I would again point to the notion that if you think about where valuations are, fixed income looks attractive from a yield perspective, despite being lower than what it was a couple months ago. But also when we look at where equity valuations are more broadly, I think it points to sort of that flow. And right now, it's hard. It has been hard to make the case that of moving out of money markets into bonds because of the inverted yield curve. You're actually giving up yield to do that. But the argument against that is that your money market yield is only good for one day, right? For the next few days. And once rates start to drop, you're reinvesting at much lower rates. So you lose that sort of protection of a rate rally or sort of the potential capital appreciation in the event of a shock. So that's where I would point to, there is a balance, when you look at sort of investing short term where yields are higher versus out in the bond market. But we have seen the yield curves, it's still inverted, but we've seen it steepen out a little bit, which will make it easier or more palatable to move out the yield curve and into bonds.
So interesting what's going on in markets right now. Let's take it. There are other questions here rolling in. So let's take a look at a couple of these. So will Canada move lockstep with the US with respect to cuts? We're already ahead at this point, but will we move more quickly, more slowly? Just kind of that differential story between how everyone's moving on the cuts front.
Yeah, when we look at historical differentials between the two markets, I think before we saw any cuts out of both Canada and the US, there was commentary about whether Canadian rates are already pricing in a fairly big divergence versus the US. If you look at 2-year rates being about 60, 70 basis points lower, 10-year rates about 80 basis points lower in Canada. I do think that differential can persist, and it is sort of at the higher end of historical ranges, though not at extremes. And I do think, given the sort of the dynamics of the impact of higher rates in the two markets, I think that can continue to persist. But what I will say is it looks like the US now is starting to kind of catch up a little bit, given that we're seeing the data turn in the US. We're seeing Powell shift a little bit and the Fed start to shift. So I would say that it's reasonable to assume that going forward will probably be somewhat in lockstep to a certain extent. Keeping in mind that Canada was already 50 basis points ahead with its 2 cuts. The one thing I think to think about too, when you look at historically the differentials, the only times that they've been sort of really out of line is just on timing. So if you go back to either the financial crisis or to the COVID pandemic, it's only because the Bank of Canada, had a meeting 2 to 3 weeks before. And so there's, when they make those large swings, like when we cut 50, 75 basis points at a clip, that you can see a discrepancy for a very short period of time. But I think we're kind of within a range right now where we should start to see it a little more lockstep.
If you're getting into bonds right now, this is perhaps those that are already invested and have sleeves and exposure to fixed income markets, and those that want to get into it. This is a moment of all in. This is a moment of get ready. What is this moment?
Yeah, I mean, I think prudent investing would tell you to kind of to never kind of move all in to anything or to move all out. You really want to be gradual and methodical about, the only times that I would have been more aggressive was, going back to the end of last year where rates were, when you had 5% yields on US treasuries, and like that was kind of a point where you really could see an inflection and made the strong case. I think with things more fairly valued now, even though the longer term profile looks positive for fixed income generally as part of a portfolio, I think you want to be gradual and take advantage of market movements. We would never advocate for trying to time the market because that's usually works against you more often than not because of unexpected surprises. So I think we need to think about what's fundamentally priced in and what fair value is, and gradually make those allocations. And so, if I think about how we approach our portfolio, even though we're strictly invested in bonds, when we see rate backups, we may be more inclined to add a little duration. And when we see rates rally, we might be inclined to take a little bit off the table. Right now, I would say we typically are pretty close to our benchmark duration. We don't deviate by much. But I would say we're targeting to be somewhat more neutral because the positioning and the technicals are very positive for fixed income, but valuations are more fair. And so we're approaching it from a more neutral standpoint. But when we do get these moves in any given period, we do try to be gradual about shifting the positioning over time.
Would you say that if you go into some of the sectors themselves, you mentioned defensiveness, that'll be a mixture of the type of asset ultimately, but also some of the sectors. Can we go into the positioning a little bit that you have on that defensive positioning with dry powder at the ready? But what does that look like?
Yeah, so if we look at our portfolios, there's a couple of things I would comment on that. The first is when we look at the composition of our portfolio, we historically take advantage of the strength of our research team and our credit research. And so we tend to have a slightly lower quality in terms of we favor triple B securities in the corporate space. But what I will say is over the last year plus, we've been reducing the extent of that exposure to triple B securities, moving a little bit more up in quality in the corporate space. But I think the second thing, the more sort of way we're being more defensive is we're trying not to sort of have blanket exposure to corporate markets or to specific sectors. We're really focusing more on individual companies that have catalysts to outperform the market. And so, we're focused on companies that have improving leverage profiles, that maybe have lower funding needs or have greater prospects. Or the other thing, for example, I guess if you want to go into actual sectors, we're favoring a little bit more towards provincial bonds and away from corporates because they tend to be less volatile and also provide a little bit more liquidity in the market. But then financials, we still like the Canadian banks, despite, the headwinds banks face is really more an equity story. They're very solid credits, very large, where you're not concerned about the credit quality there. Then you can get into other sectors like energy, for example, has been a great sector in terms of cost cutting and reducing leverage. That being said, a lot of that's starting to get reflected in valuations. And so there's something to be wary of. When we look at cable telecom, that's a potential opportunity. The large incumbent players have underperformed of late because there's a couple of industry-specific stories with regards to opening up their networks. But also their leverage profiles have kind of, as much as they have lower leverage targets, they have not really met those targets. They've kind of lagged in terms of improving leverage, and they seem to always be slow on doing so. And so as a result, more recently, they've underperformed. So while that dynamic isn't necessarily a positive from a credit perspective, it's now getting reflected in valuation. So it's something that we're starting to take a closer look at now as well.
Okay, really, really good to sort of get your thoughts on that. A couple of great questions coming in. So will government debt and the levels of it influence bond markets soon?
So I think soon is the sort of key part of that question. I don't know that it would be soon. I would say that it's more of that's something that plays out over a longer period of time. And I think it also matters if you think about Canada versus the US, and depending on your jurisdiction. I think US deficits and deficit spending will probably have potentially more of an impact on rates down the road because of the amount of funding and sort of the focus globally on US bond markets. In Canada, there's a little bit of a different dynamic. While you would expect that deficit spending and borrowing would impact rates, there really is a shortage of sort of term debt, 10, 30, even more specifically 30 years. But a lot of the funding that the federal government does is shorter in duration, shorter in nature. And there's definitely plenty of demand for that right now. When you look further out the yield curve, there's a shortage of 30-year bond issuance, even though you would think that the governments would be interested in locking in those longer term rates. But generally, that shortage has kind of kept rates lower than you would otherwise think they should be, given the dynamic. And so we have a hard time seeing a really large impact in Canada on longer term rates, but where it may filter through even to Canada is with the impact it might have in the US.
Okay, fascinating. That's so interesting. Thank you. There are more questions, but I think we'll have to leave it there. I'll just give you 30 seconds of sort of what do you not want to be underweight right now?
In terms of the bond market, I think on a more tactical basis, as much as I said, a lot's priced into the market. It's hard to fight sort of the market trend and the direction that central banks are going in. And so I think it does warrant having sort of duration exposure in a portfolio. And if you talk to, especially if you talk to our asset allocation teams within Fidelity, and I'm sure you've heard some of them speak, I think there's been a shift towards adding duration in those portfolios as well for that reason. Because of where the trend is, markets tend to, regardless of what's fundamentally priced in, when you have this sort of rate cutting cycle, markets will tend to get ahead of that, and so you're likely to see. So I think that being underweight duration in this environment, when you're seeing this pivot and shift from the Fed, is it's probably not the best spot to be.
Okay. Well, we'll leave it there. You've given us a fabulous tour. Sri Tella, thank you for joining us, and wishing you a spectacular weekend. All the best.
Right. Thank you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.